Hi, everyone, and welcome to the webinar on exit planning, the process of actually breaking down what this is going to look like. Go to the next one. There's a little bit about me. My name is Ethan Stewart. I own Centennial Financial Group. I've been in the business a good amount of time. I'm a certified financial planner. But the second hat that I wear is that I am also a certified exit planning advisor, and that is what we're going to be talking, utilizing more today, talking about exit planning, how to prepare, what that actually entails. So today we're going to be covering a couple different things. We're going to be talking about what exit planning actually is, why it's important, how it works, and then finally we're going to go into some details about what the process actually looks like and then the next steps. Okay, to start off, I know there's not a lot of people on here today, but having this question here, I'd like to start off with having a transition strategy is important for both my future and the future of my business. Do you agree or not? Go ahead and type in your answers to the question and answers. And the answer, well, it's up to you on what the answer is, but I always like to start out with that to kind of talk about the reality of the situation for business owners. So there's a couple of interesting facts. I won't spend too much time on here. But according to a survey done by the Exit Readiness Institute, about 99% of owners agreed with that statement that you talked about beforehand. At least some of them did somewhat agreed, most of them strongly agreed, but 99% of them agreed in some capacity. And now that's a little interesting because we follow up that fact that everyone agrees that it's important. Whereas there's these stats on the end kind of contradict that. And that's what's interesting about exit planning and why it's so important. 79% of owners have no written transition plan at all. 49% have none, no planning at all. And then 94% have a no written personal third act plan for after they take a step back from their business. So the point is that although people are saying that it's important, very few people have followed through with that. And that's kind of what we're going to be talking about today on what the next steps are and what we can do moving forward. So what is exit planning? So let's talk about this question first, right? So when we talk about exit planning, it could also be called succession planning, just thinking about the next step from a business owner's perspective, because it helps to answer the question, are you in good shape from a business perspective, personal, and then financial? Because what we found is business owners tend to be very involved in their business, and transitioning to their next phase of their life is oftentimes a little intimidating for business owners because they've been doing something so long their whole life that going to the next stage or taking a step back or selling their business is oftentimes very difficult. So exit planning helps get as prepared as possible around all of those things for them to be comfortable moving on to the next stage of their life. And oftentimes that involves making some paradigm shifts as a business or thought processes that need to be shifted over. And so that's what we're going to be talking about next and what kind of shifts they actually have to do. So the solution for exit planning and those paradigm shifts, go to the next one. The first one is that exit planning is business strategy. So believe it or not, exit planning isn't just about, it is planning for the future, but it's not just something that you do in the future. It's starting today, and it's part of building a valuable business is building that exit strategy of what's going to happen when you finally want to take a step back as a business owner, or something were to happen to you, things along those lines. It's very important to do it, and it's present tense for that reason. You're starting up front immediately, and just the process of planning around an exit will help build value. Now, there's 5 stages of actually building value in your business, or what we call value maturity, and that's identify, protect, build, harvest, manage enterprise value. So you do those each steps and opportunities to build value in a very manageable way as you look towards exiting. And it's a process, and we'll get to how that actually looks here in a second. But then also you want to simplify the process, clarify the roadmap to success, break down what is the process, break down what you have to do to actually find success for you personally as well as the business end. And you do that through what we call the master plan and balancing the three legs of the stool. And that is the three legs are personal, business, and finance. You need all those balanced as a business owner. Otherwise, most likely any sort of exit you're going to be doing is going to fall through, right? So those three legs of the stool you'll hear me talk about a lot through this presentation, because it's all about making sure the business in a good place, you personally are in a good place, and then financially you're in a good place as well as the business, so that when you take a step back, everything will be okay and won't fall apart, because that will cause you not to take a step back. So it's important that we integrate all these things into the business. But the main thing about this paradigm shift is that exit planning is an ongoing process, and it is good business strategy, adding value to your business almost immediately. So the second paradigm shift is value becomes all about transferability. Now, this is a key differentiator in building a business. Is there's a difference about building a business with the intention of eventually making it transferable versus building a business that is all about income, right? So value should be the primary goal. If I am looking to purchase your business, this paradigm shift is talking that if I'm looking to purchase your business, you want to build a business that's valuable so you can get as much as possible from that sale. And me as the buyer would be willing to offer you as much as possible for the sale. Now, this is very different than a lot of people build their businesses, or this is very different on how people build their businesses, is because if you're building what's called an income-based business, I'm not necessarily buying anything if you're the one running that machine. So there's a really good book, the E-Myth Revisited, and this book kind of talks about making a business into a machine that can be run. Now, if you're the only one that can run it, it's less valuable than if it's a machine that runs itself, if you're at the helm or if at all. So you really want to try to build value in the business to make it as easily transferable as possible to get the most value out of the business. Now, you can have both, right? You can have a valuable business that creates income. However, only if you focus on value first. So you always want to do that over income if you have the intention of selling it at some point. And that's the exit planning process helps to reorient that. So you know, don't get discouraged if you aren't in that place from a business standpoint. It just means we need to get you back on track. So that's the second paradigm shift. Third paradigm shift is going to be adopting a common framework. So there are right ways and wrong ways to do exit planning, and one of the methodology we're going to be talking about and we use through the SEPA process is what's called the value acceleration methodology. It's a proven process that can be utilized ongoing to help build that value in your business and help align those three pieces of the stool, or three legs of the stool: business, personal, and financial, so that you as a business owner can exit knowing you get the maximum value that you could out of your business while exiting when you would like. We're going to be talking about some statistics here, but it's frightening how many deals actually fall through because the business owner isn't excited about the next stage, or the third act, if you call it, of their life. So it's very important to have these balanced and to go through a proven methodology like this value acceleration methodology in order to be able to get what you want. Let's go to the next one. So now we're going to be talking about why exit planning. Why is this important to be done? I already kind of touched on it, so we're going to go through this relatively quickly. But just some quick statistics that I like to put out there on what the kind of need is out there in the market. So right now, some of the big ones that I'll point out, I'm not going to go over all of them, is that 80 to 90% of the owner's wealth is trapped in their company. This is why exit planning is so important, right? Is if you have no way to capitalize on that exit, what you get into a situation that the situation that I call the business owner conundrum. You oftentimes have a very valuable asset, i.e. the business, but the only way to capitalize on it is either to sell it or find a successor. And this is all about exit planning. It's all about capitalizing on the value you've built in your company. Because I can't go to the bank and just, spend some of the value of my company. I need to actually sell it to get that value, and then manage it effectively afterwards. So that's a really big one, and surprising, but, well, not unsurprising, but frightening in some ways. And then another one that I want to point out is 75% of owners profoundly regret selling their business just a year after selling it. Now, most times this is because of either a non-proactive sale. And we'll talk about that in a minute, but basically you're selling because you have no choice, or the business owner really didn't do the planning of what life looks like outside of the business. So, and that's going back to the stool, right? You need to balance business, financial, and personal to make sure that you're excited about the next steps. Because again, as a business owner, you're not going to just go and leave your baby to the side and not care about it, succeeding, and or you've been doing something your whole life. It's not that you can just turn it off. So it's very important to have everything in balance through an exit planning process to ensure that any sort of exit you do, any sort of capitalization you get on top of the value of the business is done in the most effective way. So this is easier said than done. So starting to go into the details of what the process actually looks like. Before we get to that, there's three main challenges that business owners typically face. Go to the first one. First one is that many owners are unprepared. So this is, again, going back to just the exit planning process and just thinking about it, and why exit planning is good business strategy and why it adds value immediately is that many owners are unprepared for what it actually takes to exit and or what's after exiting. So there's a lot of uncertainty around that, right? What's going to happen to the business? What's going to happen to me after I leave the business? Where I'm going to get my money? Do I have enough? Et cetera, et cetera. That's a very important one, and arguably the most important is to be psychologically ready. Income trap, a business can oftentimes be a trap in terms of if that's the only income you're getting and your only source of income, then again, you don't have a valuable business, you have an income generator, and that needs to be switched. Again, what's next, right? After you take a step back, what am I going to do with my life? How am I going to spend my time? That's a big, believe it or not, a much bigger question than it may seem for business owners. Confidentiality. Do I want to share things about my business? Do I want to share things about me, et cetera, et cetera? That all can come into play. Not a bit of urgency. Some business owners don't want to exit, and which is fine, but those that do, that just put it off, there's no urgency for them to do anything. But COVID was a good example of something could happen that maybe you don't want to continue in the business. Maybe a business isn't as smooth as it seems. So urgency can shift pretty quickly. And then misinformed. There's a lot of not good information and not a lot of good information out there for business owners. And this is part of why Centennial is trying to get this information out there, is to really spread the word of what an exit plan actually is for business owners. Because there's a lot of confusing information. In the age of the internet, there might be too much information, but the question is, what's the good versus the bad? So that's challenge one, is being unprepared. Challenge two is involuntary exits. This is what I was talking about, of 75% of exits are regretted in the first year, is because 50% of exits are involuntary. Now, these bullet points are what we call the 5 Ds of involuntary exits. And these are the situation that one of these can cause a reason that you have to exit or you have to sell your business. A big example is death, right? If you're the main provider of your business and the business can't run without you and you die, what's the business going to do? Most likely either going to collapse, or your spouse will have to, or your spouse, your loved one, whoever inherits it, will have to sell the business for whatever they'll get for it. So very likely the value you want will not be the value you actually get in a death situation. Disability is the same thing. What if you couldn't continue in the business and you had to sell, and you couldn't work, so you had to sell to get whatever you could? Divorce, we all know that divorce can be very, very expensive at times. What if that happens? How does that affect the business, the cash flow? Where do you get the money to pay for things? Distress, business is one of the hardest, running a business is one of the hardest things you can do. So what if you get into a situation you just don't want to continue the business and you just want to get whatever you can, and because you just can't take it anymore? It can cause you to do a bad sale. Disagreement, if you have partners, anybody who's ever had partners knows that there can be good partnerships and bad partnerships. There can be good spousal arrangements, there can be bad ones. And if you have a bad arrangement and there's some disagreement that goes on, it will cause business to sell for less value than they should. So the second challenge for a business owner is doing a business and selling your business proactively to get the value that you should out of the business, not because you have no choice. And the third challenge is not focusing on value as a business owner. And so what I mean by this is that many individuals or many business owners are so focused on creating income, right? Is creating a business that generates income. Now, that's not necessarily a bad thing, but what they create is what we call lifestyle businesses, right? They're businesses that you either run, or maybe you have a team or you have a business, but it's so reliant on you that if you took a step back, you wouldn't A, make money, and B, the business wouldn't work out. So what you've created is essentially a very complex, sometimes a very profitable paycheck for yourself, but it's very difficult to actually exit that situation. Because if I'm coming to buy your business and it can't function without you, but you want to leave, then I'm not really buying a business, right? I'm buying maybe a name, maybe some other things that don't get you nearly the value you need. So what we try to encourage through the exit planning process, and what we'll be talking about, is building what's called enterprise value. And that's the actual value of a business, so that when you go to potentially sell it, that somebody's buying a valuable asset from you and will actually give you the money that you expect to get from that sale. And that's why it's so important. It's the big challenge is most business owners, I would say, have not looked at building enterprise value. But again, that's part of the exit planning process, is to fix that and get you back aligned to maximize that enterprise value. Okay, so now we're going to be going into the actual process, the actual content of this presentation and this webinar, and that is how exit planning actually works. So we start with what's called the value acceleration methodology. And the value acceleration methodology is a proven process that focuses on growth and aligning business with the 3 legs of the stool for the master plan. It's grounded in action, and this is one piece that one of the words that I want to really emphasize. You'll see through this process and the methodology that we're going to be going into, there's a lot of focus on action. And as any business owner that has been through a business or run a business knows, action is all that matters. Talking about things, analysis, all these things don't matter except the actions that are behind those numbers, right? So it's all about action in a business as well as exit planning. And one thing also I want to kind of point out on this is that this is very much a team sport, right? Me as a certified exit planning advisor, I tend to take the role of a guide, almost like a quarterback that coordinates all the professionals. But I'm not a CPA, I'm not an attorney. Those are all some examples of professionals that are actually needed in this whole process. It's very much a team-oriented sport. By combining all those things together, you'll create a roadmap of actual actions, of actual deliverables that can be executed to create value, and oftentimes a big leap in value, which we'll get to in a moment. Go to the next one. So I'll put this to the group. I know there's not a lot here, but what's in your mind, I kind of already talked about it a little bit, but what is the difference between a value creation business and a lifestyle business? Go ahead and type your answers in the Q&A. Go ahead to the next one, Christine. So before I get to the process, the answer between that is the lifestyle. Again, a lifestyle creation business is one that's more cash flow driven, and a value business is more having the value to be actually able to sell the business later on. So let's go into the process. So this is what's called the value acceleration methodology. And this is the high-end view, and we'll get into each section. So there's 3 main sections or categories of this whole overall process. Now, To be clear, this process can take time. It can take, I always say I work with business owners 0 to 3 years from exiting, potentially more, because it can take time depending on what kind of situation your business in. So there's three main sections or gates, as we call them. First one is the discover gate, or the discover section. Now, this is where you actually analyze your business, figure out what you need to about the information on your business. And then the prepare stage is where you prepare the business to actually be sold. So this is where the actual value creation is built. And this is where most of the time is spent in actually building and improving the business. And then throughout this whole process, you're always assessing this decide section, or this decide stage. Now, the decide stage is when you actually decide one of two things, and that's a keep or sell. Now, you're always, why it's an ongoing question is that while you're building value, there may be a point in time when you're just like, I just don't want to do this anymore. I want to take what I can, in which case you're going to sell. But also you want to assess this, because if you want to keep it and continue to build value, then you want to be able to do that as well. So we'll get into each section now, but I wanted to give you kind of high-end explanation. So we're going to start with a discover gate. So there's a couple of main pieces in this, but if you look at the visual over to your top right, the first couple of pieces of this process is to do an analysis on the business. And that's pretty straightforward. You want to conduct an annual business evaluation, and then you want to assess your personal, financial, and business, how everything is structured for those three legs of the stool. So there's a couple tools that we use, and one of them is an exit readiness assessment. So we ask a lot of questions here, but the main ones are, are you and or your business ready for an exit? And then it gets to, that leads to further questions. Can you increase your business value? Yes, no, how much not, etc. What risks are out there? Oftentimes risks are the easiest way to add value to the business, so we want to assess that. Quantifies evaluation. There's a valuation that's done, which is that second section I'll talk about in a second. And then determine where you stand in terms of an industry standpoint. Are you selling more than you should, less than you should, things along those lines. It really just does an assessment from your readiness standpoint. And then another big piece that we do is look into the business valuation. Now, there's a couple of different ways in an assessment standpoint to do a business valuation. The first one is, and the reason is that from an accounting perspective, you can do a certified assessment. There's different times that you want your business to show value at different for different reasons, right? If you're looking to sell, you want to try to make your business as valuable as possible. If it's to a family member, for example, maybe you don't want it as valuable as it could be. When you do taxes, you want to make sure that you are showing as as minimum value as possible, so you don't get hit with taxes at the most amount. So there's different methodologies to do actual valuations. So what you're trying to show through this certified valuation is what is a business entity that, if purchased, what kind of value will this business bring? And so there's a different ways to do this, but that's what you essentially want to do, is make sure you assess all your, we call them the intangibles of business valuation. These are intangibles that can't necessarily be, measured or quantified, but are on their own, but need to be to add to the value. So we're talking outside of assets and other things. So the business valuation really tells you a couple of things: how you're performing relative to the industry, your financial opportunities or strengths, what can be improved on, the need for personal financial planning, which I'll get to in a second. That's a very important piece. Is through the evaluation process, keep in mind, we're not just planning for the business, we're planning for the business owner to take a step back from the business. So we want to make sure that their financial plan, their personal plan, is set up for when the business is no longer part of their life. So a planning or a certified financial planner is going to be very important in the team-oriented approach to make sure that they're excited and in good shape from a financial perspective. And then it's assessing the need for strategic planning, if at all. Now, one thing that we also want to prioritize in this is de-risking action plans. So again, through this process, you're going to see there's a lot of action items. There's a lot of deliverables that are done in each stage of this planning process because we want to focus on action, okay? And one of the ways that we start, so this is assessing, this is preparing, and this is discovering for the prepare section. And there's some de-risking strategies that can be done soon to add almost instant value. And you do that by assessing, you know, how you are from a status standpoint for personal, financial, and business to make sure that you're ready to actually exit. And then what you do is set up this 90-day, what we call a 90-day implementation schedule, which we'll talk about here in a second. So that is the first kind of section of the discovery gate. Go to the next one. Now, some of the deliverables that you get, and again, in each gate or in each section of the process, you're going to get some sort of deliverable, some sort of action items from this whole process. And in the first gate or the first section, the deliverables that you should be getting is a specific and qualified list of personal, financial, and business strengths and weaknesses. Again, we assess how you're looking from a personal standpoint, how your financial picture looks, and how the business looks, the strengths and weaknesses, what needs to be improved upon. Correlated and used to justify present value and potential value. So there's a couple of gaps that we look at, or things that we call gaps. And that is something called the value gap, which is the gap between where your business is valued versus the industry leader. Is there any sort of gap there, right? Then the other one is the wealth gap. How much money do you actually have to sell your business to create the lifestyle that you need to? That's a very important one. And then the deliverable ends up with, okay, how much do we need to grow the business at all? So we know as we go into the prepare gate and the prepare stage, how much growth or how much value we actually have to add to the business. Because again, that's a very important assessment, because if you're finding that, all right, I need, you know, $10 million, but my business is valued at 5, it's going to take a lot longer than if I'm at 9 million and I need 10 million, or maybe I only need 9 million. So this assessment really helps answer the question of, is there any more value I need to build in the business? Maybe not. Maybe I just skip the prepare stage and go straight to the decide stage and decide I want to sell my business because I'm going to get what I need. So this kind of assessment is very important to do. And from this, you then create an action plan. Now, the action plan, again, think of the discovery gate as kind of preparing or getting ready for the prepare gate and actually building the value of the business. And from this, you get a prioritized action plan, which breaks down the personal and financial actions that are needed to be done, and then the business actions. We call this the master plan breakdown, getting ready to start executing. And these will be implemented in 90-day sprints. Now, this is a very important number, okay? And the reason that we decide or we use 90-day sprints is for anybody that's run a business. If we just look at a yearly accomplishments, they're very, very less effective than if we do these 90-day time frames. The 90-day sprints are so powerful because it's long enough time period for your team to accomplish a lot, but it's also short enough time that they're not doing so much and overwhelmed and just they lose focus. So 90-day sprints are a very important time frame because they get that sweet spot of being able to execute effectively. Okay, so continuing on Discover, again, the action items that you get are going to be the 5 personal actions, 5 business actions. This is an example of some of the stuff that you could actually take into the prepare gate to actually execute on. But you want to come out with actions that you can, actionable actions that you can execute over the next 90 days as you prepare to build value in your business. Okay, so now we're going to gate 2, or the section 2, which is called the prepare section. So if you go to the next one, so what prepare is by far the longest period is where you actually do the execution to create value in your business. So it's very dependent on your business. So there's no generic time frame, there's no generic process. All these things are contingent on your business itself. Some businesses are going to be more complicated, therefore it's going to take longer, et cetera, et cetera. So it's very dependent on you and your business. And that Discover Gate now analyzes, okay, what do I need in my business to start executing the prepare? So some of the examples that you're looking at are personal and financial planning are the things on the personal and financial side. Maybe your business is in the right shape. You need to work on personal financial. Again, going back to the three stools, you need personal, business, and financial to be balanced to be able to have a successful exit. Business improvements. Are there some improvement opportunities in my business to create more value? Sometimes there's very easy implemented things, which will cut the time frame down quite a bit. Assemble proof. We need to make sure that we actually put together the proof of these things that we're going to be working on and what we need, which will help us prepare and start this master plan or this grand execution journey that we can start building value in those 90-day sprints. Go to the next one. Okay, so a couple examples of in these categories, what we're going to be looking at is personal financial. These are some of the things that you want to look at as we go through the prepare gate and as we start executing on the personal financial side. What personal purpose is the business serving and how do I replace that? This is, believe it or not, a very important question that a business owner should ask. Oftentimes, business owners are so ingrained with the business that they almost start, merging themselves, their identity with the business. So when they take a step back and leave that business, it's hard to, oftentimes you get hit with this reality of, I'm no longer a business owner, I don't own X, what do I want to do with my life? So it's very important to answer this question of what's my purpose that the business owner created and how do I replace it? Maybe if you just want to switch purposes, maybe there's something that you've achieved with the business, you want to do something else. That's fantastic. But that's why it's so important to at least think through that so that you are ready to start executing on that when you take a step back. Can you achieve your personal objectives without your income? This is, again, something we call the wealth gap. A business is oftentimes a very large percentage of your net worth. You want to make sure that you sell and get what you need to replace that income that you're no longer getting, because depending on what your exit is going to look like, you may not get the income or most likely not the same type of income that you were getting when you were working there. So you need to make sure that's taken care of, and a good financial plan will help assess that. Are you confident you'll never run out of money? Again, that's what a financial plan will answer. Who depends on me? This is oftentimes a team game of talking to your family and just really having a sit down heart to heart of, okay, what do we need and what do we want to do in the third act of our life now that we're leaving the business? What does that look like? Who can I help? Oftentimes people want to be able to help where they can and they won't have the backing of the business anymore. So you want to make sure that you can continue that. Can you stay healthy? What kind of contingencies can you plan for? Insurance planning, needs versus want. What do you actually need versus what do you want? Estate and taxes, et cetera, et cetera. These are all things that need to be looked at. And with a certified financial planner and a good financial plan will answer a lot of these and help orient you with your finances as we prepare to add value and actually exit. Now, believe it or not, this is part of adding value to your business, because you as the business owner, you're deciding to exit or not. If you don't have this stuff set up for yourself, then you're more likely to get cold feet and back out of the actual deal. I don't have the statistic up here, but a large amount of deals fall through because owners get cold feet and actually moving forward. And this is oftentimes because of all these things that they're personal and their financial side. They're not sure what to do next. They're not sure if they have enough money. And that's why this planning is so important. It adds value all on its own for the business. Because if I'm buying your business, I can't get any value if you're not willing to sell. And this helps you get comfortable with actually taking a step back. Some business improvements. Again, I won't spend too much time here because this is very dependent on your business, but there's some low-hanging fruit that we always start with, and that's looking at de-risking value enhancement projects first. So we always look at de-risking. and protecting against those 5 Ds, right? So adding value is oftentimes as simple as getting a buy-sell insurance or some sort of solution to protect against the death of a business owner. That right there adds value, because if I'm buying a business from you and something were to happen to you before we actually settle on a deal or before the business got to where I wanted, that hurts me as the person buying your business, and potentially hurts your the loved ones you leave behind from getting the value that they want. So de-risking and protecting against those 5 Ds, against death, disability, disagreement, divorce, and the other one is very, very important, so that your business will always continue no matter what happens to you. And it's oftentimes a very simple thing to do and less complicated. So that's always what we start with, because it's easy and quick and low hanging fruit that we want to take care of, that adds that value almost instantly. Governance and team building. So we want to make sure that your business will be able to run itself. You have the right team. So that's the second piece that you are looked at. Efficiency, systems, and improvements. If I'm buying your business, I want a machine that runs well. So we want to make sure that it runs as well as possible with or without you. So this is another big improvement. Expansion, sales, and marketing. We want to make sure that you have consistent growth. Again, as a business, as somebody buying a business, I don't want to buy something that's going to be stagnant. I want to buy something that has the potential for growth. So expansion, sales, and marketing are one of those things. And then culture. This is becoming more and more of a importance, but also recognition of how important it is to a business. All these other things will do better with the right culture of the business. And again, if I'm the business owner, but I'm driving the culture, I want to make sure that culture will maintain and be sustainable with or without me, if I'm staying around or not. So these are just some examples, and this is much more complicated than it seems. And these are often topics that we can go very, very in depth in. But business improvements are the second stage, or another factor, but arguably less important than the personal and financial planning, because all this doesn't matter if the business owner isn't ready to go. But that's why we balance all 3 of these things, right? The business needs to be in the right place and get the value you want. You personally need to be ready, and you need to make sure you have the money financially to be able to take the next step back. So that's why all this kind of works together in a lot of capacities. But this is the next piece that we do for the prepare. So the action items we typically try to get out of the prepare gate, again, this can vary from a time frame standpoint, but are very much, these action items are really what we try to commit to. And that is try to create a vision 3 to 5 years of what the business is going to look like, what your exit is going to look. I would say 0 to 5 years, because it could also be, relatively quick. But again, it greatly depends on the business itself. But you want to get that vision of, this is what I'm trying to get to add as most value as possible. You want to focus on the next year and 90 days. So in planning, right, you always want to, most people here, I'm sure, have developed a 5-year, 10-year vision. But from an execution standpoint, you don't want to look too far out, because so much can change. So you want a vision and something that we're planning for, but then where we want to actually break down action items, actionable items for the year, and then knock that down to 90-day sprints, or those 90-day chunks, to be able to take a chunk out of things. And that will add up to progress over time. You want to align the team, you want to assign accountability. So there's this is a more complicated process than what I'm going to be talking about, because again, it's complex, but you're dealing with people, and your team is part of adding value to your business. So you want to make sure they're on board. You want to make sure that they are on board for the 90-day sprints, creating value in the business itself. It's a very important thing to be doing. You want to commit resources. This is not going to be free. I'll tell you that right now. You're going to pay for people's times, as well as investing into your business. So be prepared to invest into your business before you capitalize on it, if you actually want that value from this, this growth. Establish a measurement and feedback process. You want to, you've heard that saying, I'm sure you've heard that saying, what isn't measured doesn't actually grow. So you want to make sure that you're getting that feedback consistently. And then you want to communicate your plan, communicate the rhythm to really start executing on these 90-day sprints. Now, one thing you want to do, and we'll get to the final gate here, is every 90 days, you want to reassess. Part of the execution process is to reassess this plan and reassess the question of, am I keeping or am I selling? Which we'll talk about here in a second, because at some point in time, as you're building value in your business and going through this process, you may get to a point where, look, I know I need to get this number. I don't want to do this anymore. I want to take a step back, in which case we try to capitalize on what we have at the moment. But that's why it's so important to revisit, because what the exit plan in the end is doing is trying to get as much value as possible for the business owner so that they're excited and ready to take a step back and actually exit their business to their the third act. And so revisiting and making sure that they're going through this process as they should is very important. And in the end is the most important thing. So gate 3, let's talk about the final stage in the overall process, and that is the decide stage. Now, in this stage, go ahead to the next slide. In this stage, it's pretty straightforward, and that is because every 90 days, you're going to be, as you're going through the prepare stage, as you're building value, every 90 days, you want to ask this one question, and that is, do you want to grow or do you want to exit? And now there's again a lot more complicated things to take into and keep in mind. Maybe the market timing's changed. Maybe the market itself has changed. Maybe a business life cycle. Maybe your time frame, personally, health gets in the way. Things can change, which is why it's so important to assess. Maybe you're just tired of doing it, like I was saying. All these things need to be looked at every 90 days to ask that question: do I keep or do I sell? Then you want to discuss actual sales strategy, actually transition options, which we'll talk about here in a section of, if you do decide to sell, what does that actually do? What does that actually look like? So if you decide to keep it, you just recycle into the prepare stage and go back to building value. Then the next 90 days, you look at it again, keep it, go back, and keep on doing that until you get to the 90-day step where you ask this question, keep or sell, and you finally at the decision of like, you know what, I want to finally take a step back and I want to sell, which is when you start assessing and look at what exit options make sense for you, which we'll now talk about, or we'll talk about here shortly. So some of the things that you want to keep in mind when you're asking these questions is a risk reward. Advanced value acceleration typically takes about 2 to 5 years. So again, it's a time frame standpoint. Do you want to commit that time? Do you have that time? Do you want to have that time? That's a big question to ask from a risk reward standpoint, and that will impact your decision to keep or sell. It's going to require some investment in the business. It's going to require some changes. So are you willing to commit and do those hard things that get the value you want out of your business? But there's a lot of reward for doing these kind of investments and this kind of process. Although there is going to be a large increase in complexity, that will often increase rewards by a factor of 2 to 3, if not more times in value if you do all these things. So the risk reward, although it's a risk investing in this, taking the time, a lot of things can happen. But if you do things right, the value will absolutely be there. And there's very little downside to doing this besides just some pain and some money. And as a business owner, you're used to pain and money. So that's a small price to pay to get and be in the lifestyle that you guys actually want. Now in the transition, there's a couple of stages that you should look at, and that's explore exit options. We'll talk about some exit options from a high level standpoint. The next webinar we're going to be doing is actually going into these in a little more detail of what the actual exit options look like. Comparing options, then you select the best option for you, and then you start executing on the transition plan as well. And again, sounds a lot easier than it actually is. It's definitely a team sport, but it's very important to ask all these questions and go through the criteria. Okay, so there's two in the actual deciding, and now you're looking at what are the actual exits that I can do. There's two main categories that you look at for what the actual exits look like. There's inside and outside. An inside is some sort of inside or internal entity buys you as a business owner out. I think of this as more of succession or a way to continue the business internally. And then outside is finding an outside person, entity to purchase the business itself. So we'll go over each one. So inside is intergenerational transfer. And that is where you're transferring to a family, next of kin, if you will, or some sort of a family member. Now, this is one of the more common, but it's also ironically one of the biggest pitfalls business owners make is they anticipate that their child, son, daughter, whatever it may be, want to take over the business, and they're banking on that and anticipating that happening. Suddenly, the child decides that they don't want to do it anymore. And that can cause a lot of I hear business owners say, yeah, it's okay. I have a plan set in place. My son will take over, my daughter will take over, whatever it may be. But I always think in the back of my head, that's not necessarily true. So it's a pitfall people make, although it's also a common approach and a very good approach if you can find a family member to continue the legacy that you built. Management buyout is where, as the name implies, you get some of your higher end management to buy you out. So this is not necessarily partners, but where you could band together some high end managers and actually be able to find a pool the money together to buy you out. And if they're running the machine, why don't they start, transitioning to owners by buying you out from and them turning from management to decision maker or partners. This is a very utilized approach to find a buyer for your business. Sale to existing partners. Now you need partners to do this, but this one's pretty straightforward. If you're all partners, then the existing partners buy out the new partners. It's very easy way to find a buyer. And then sales to employees. So this is one that a lot of people aren't aware of, but they can use some methodologies that will allow them to sell to their employees themselves. Again, if your employees are running the business for you, then why couldn't they become partners by buying you out as well? So that's another strategy that you can do and utilize some more advanced strategies to actually fund this purchase. Now, from an outside perspective, there's a straightforward one, which is sale to a third party. You find a buyer. If it's a friend down the road, if it's somebody you find on the street, if it's a broker, whatever it may be, but you find somebody that's willing to purchase your business. Now, this option can oftentimes be quite valuable if they are purchasing you for a value standpoint, meaning that they're purchasing your business because they think it adds value to the business. There's different ways to structure your business and sale to a third party, but oftentimes this can be the most profitable way to get some money for your business. Recapitalization, that's basically you need some funding, so you allow an outside investor to give you some money in exchange for some ownership of the business. Now, oftentimes this isn't a full buyout. Sometimes this is just a partial one, but that's another method that you can do from an outside perspective to exit. Now, IPO, initial public offering, is a methodology where you go public and sell on the public market. Now, this is a category that most people watching this webinar won't be worrying about. But this is obvious. You could go public if you are a big enough enterprise. Most small to medium-sized businesses won't have to worry about this. And then orderly liquidation is more of a unintentional exit option. And this is where you're selling off all your assets. This is not ideal, as you won't get as much value as you would like out of your business if you go this route, but it is another option. So these are some of the categories that you can do and some of the option methods that you can take to get some value from your business and actually look at selling your business. Like I mentioned, we're going to be doing another webinar that's going to be going into more of these details and how this looks from a high-end standpoint, but I wanted to at least cover these to make you aware of how that process works. So that is the value acceleration method and the process of exit planning. You need to discover your value, make sure that you assess your business accurately, make sure you assess your personal financial accurately to create a prioritized action plan. Action is everything. And that's where it brings you to your prepare gate, where you execute this action plan. You take action every 90 days, building value by focusing on your personal and financial planning, as well as your business improvements, anything that needs to be done that was identified through the discover stage. You start working on that and building that, create a master plan, executing every 90 days. And while you're executing every 90 days, you always ask the third question of the decide gate. Do you or do you not sell? If you do, when, how, what does that look like? If you don't, repeat. And just keep on doing that until you're building the value and you're getting your business to the place that you want from a value standpoint to be able to exit in the way that you actually want to. So the question is, are you ready to begin? So we have been talking about action all day. Go to the next one. And as you, as a business owner, know, action is everything. You did not get to where you are without it. As a business owner, especially, action is everything. Execution is everything. And it'll give you the time to use it and to get it where you want to go. The business itself, if you execute effectively, especially through a well-structured exit plan. So as a thank you for coming or watching this webinar, I am offering anybody who is on this webinar or sees a recording of this webinar a complimentary 30-minute Ask Anything session. Just reach out and mention that you were part of this webinar, and I'll be happy to jump on a call with you or set up a Zoom to talk through what your business looks like and answer any questions about your business exit desires. If you want to learn more, you can go ahead and check out our website, check out more about our exit planning. We do a lot of content on there and going to continue to do more. You can join our newsletter to hear about our next webinar. But either way, get in touch. We'll leave this slide here at the end. Go ahead to the next one with any questions with my contact. But I appreciate everyone's time. Thank you for joining. Thank you for listening. If you're listening to the recording, we appreciate you. And I hope you have a great rest of the day. And I hope that you have a successful exit journey through whatever stage you are from a business standpoint. Have a good one.